Okay, so these are the practice problems on monetary policy and using monetary policy options to manipulate the money market and to manipulate T accounts in the money supply. So make sure you take a minute and complete these problems from our classwork, or I'll make sure to pause right here, pause the video, and try and complete this problem, and then we'll go through the solution. So if you haven't done it already, pause right now, and then I'm going to start the solution. Okay, so part 1 here asks us to identify or define the federal funds rate. So the federal funds rate is the rate at which banks borrow and lend from each other. Interest rate banks charge each other. Remember that when banks are short on their reserves at the end of the day, they can take out an overnight loan from another bank, and that is called the federal funds rate. That interest rate is called the federal funds rate, and it's determined in a market called the federal funds market. Really, the federal funds rate is the nominal interest rate that we're going to put onto our money market in just a moment. So if the Fed wants to decrease the federal funds rate, if the Fed wants to bring the federal funds rate down, a decrease in interest rates is created by an increase in the money supply. And again, we're going to show that below in just a moment. So specifically, they're asking now what open market operation would be an appropriate open market operation in order to increase the money supply. Open market operations involve the Fed buying and selling bonds. And our simple kind of mnemonic device here is that buying bonds equals big money supply. Buy equals big. So the answer here is that the Fed should buy bonds in order to increase the money supply. If the open market operation, the buying of bonds, is equal to $10 million and the reserve ratio is 20%, what is the possible change in the money supply? So we know that the change in the money supply is equal to the change in excess reserves in a bank times the money multiplier, which is 1 over the reserve requirement. So in this case, we have a money multiplier of 1 over 0.2, which is going to be 5. And all of the bond purchase, $10 million, is going to become excess reserves in a bank, money they did not prior have. So 10 times 1 over 0.2, 5, is going to be $50 million. Is the maximum change in the money supply possible courtesy of that open market operation. And then lastly, let's put this on the money market to tie all the pieces together. So a money market is the quantity of money versus the nominal interest rate. We have a vertical money supply in this case because the money supply is controlled by the Fed, and a downward sloping money demand. And because we just increased the money supply, we can increase the money supply here, and we see that the interest rate goes from an original RE over to R2. So we see that the increase by buying bonds did in fact lead to an increase in the money supply and then a decrease in the federal funds rate, right? So we can say one more time that the increase in the money supply leads to a decrease in the nominal interest rate, aka the federal funds rate.